thank you for tuning in. This video is supposed to serve as a how-to guide if you're beginning your journey into value investing. All you need is a computer with access to internet and 6th to 8th grade understanding of the subject of mathematics. I'll put tickers across the video so that if you know some concepts you can skip past those. And please note that I'm just a random guy on the internet. I don't intend to make this video about stock tips. I barely know how much salt needs to go in my oats, and you don't want to be taking stock or investment advice from me. This is not what it's meant to be. Please treat this as a form of entertainment or learning if that ends up being that for you. In these times, I think it's important to understand capital and take control of it. Most people think of money as a piece of paper or some numbers in the balance sheet, but if you look at it, it's you trading the goods and services you produce and exchanging it for somebody else's goods and services. So if you think of the resources available to you in terms of time, energy, and capital, time is always going down, energy tends to fluctuate, but capital has the potential to multiply. It's the only resource that perhaps has a potential to multiply, and if that idea resonates with you, you perhaps want to give it a little more thought. Now, if you're beginning, perhaps indices are the way to go. But if you are a little more curious, this might be of some help. When you start out on this journey, people tend to look at some index, whether it's the S&P 500 or a global index or a country-specific index. And while those are great ways to start your investing journey, they're not perhaps the place of best returns if you're an enterprising investor. And the reason for that is you can still, by the way, beat most of the folks out there by sticking to that strategy, but that has been historically the case. The other school of thought that is coming up is that perhaps it's an overfished territory. Since everyone is doing that, it tends to have diminishing returns because it's an overfished pond, so as to speak. So if indices are overfished, how does an average individual get access to the things that have historically worked for decades and perhaps a century, and use those principles to get above average returns? Above average, by definition, would mean that very few people get to that, and perhaps these techniques put together some tools and techniques used by the best folks out there. We did speak about investing, so the next thing I'd like to introduce you to is the rule of 72. 72 is a magical number. The answer to all of life's questions and everything within is not 42 as Douglas Adams put it. It's perhaps 72, because it gives you the answer to the question, how soon will the money double? If you divide, if you expect your rate of return to be, say, 8%, it will take you 9 years to double your money. So let's say you start your pod with 10,000 rupees or dollars. At the end of 9 years, if you manage 8% return, you will be at twice of that, right? And same thing, right? If you want to double your money in say 5 years, you can put that in, and then your required rate of return would be 14.4, which is very, very respectable to achieve for a consistent period of time. Like you could hit it in a day or two, even a month for one-off case, but to achieve it over an extended period of time is where uh, it tends to get difficult. So what is rule of 72? It's a very back of the envelope way of arriving to either the number of years it takes to get to a double of whatever capital you begin with, or it is the rate of return you would require to get to a double within a certain period of years. I hope I said that right. But yeah, like you input one and you get the other. That's the crux of rule of 72, and it seems to work with that number for most rates of returns in most years with a fair level of accuracy, and we can get into the mathematics of that, but it's a magical number, and that's the rule of 72 for you. You can even extend that and see how much a certain amount would be in 5 years, 10 years, 20 years, and project and figure out what you want towards your retirement pot and work backwards, or if you're planning a big expense in 3-5 years, you can extrapolate that. So rule of 72, very important number, because the only question that matters is how soon you can double. All right, with that, let's begin into looking at some of the deeper concepts. Like one core concept is the difference between price and value, and one of the best ways this is described is price is what you pay and value is what you get, and they're not at all the same. In practical terms, price is what anything is trading for, and these things are updated very, very frequently. However, and they go up and down, like prices can go up and down, but the intrinsic or the true value of anything, whether it's a farm, a car, a business, tends to remain same for an extended period of time. And it is this difference between the price and value is where the gains come over time. In the short run, the price holds, and in the long run, the convergence between the price and value takes into effect. Right? You can think of prices in the stock markets as voting machines in the short run and weighing machines in the long run. Again, this quote is perhaps attributed to Ben Graham from the Intelligent Investor. And another key thing to keep in mind before we begin is the concept of circle of competence. If you know nothing about steel, it's perhaps not best to look at companies that are operating in steel. You can stick to something you know and understand, and a few great quotes on that space is it's okay to have a small circle of competence, but it's very important to know where the boundaries lie. With that long monologue, let's get into some real meat and some valuation metrics or screeners. Now, if you are a retail investor, as it's called, you have about 5,000-ish stocks, whether you are in United States or India. You have about 5,000 stocks each in the entire space you can buy from. So where do you begin to sort of reduce the space or ponds you fish from? And a few ways to do that is by some valuation metrics or screeners. And we're going to look at some, and then I'll leave some for you to research, right? Beginning at the market cap, right? So market cap is if you were to buy any company today, pick one, and at this point I'd ask you to go to uh, any finance website of your choice. Here I have Yahoo Finance open, and pick a company of your choice. Let's say everyone knows Tesla, and try and look at the market cap. So market cap, as I was saying, is the cost of it, what it would cost you to buy the entire company. Now, if you were to buy Tesla and the other individuals who are willing to share today, if you had around $550 billion lying around, you could buy the entire company from Mr. Musk and others who have the shares of Tesla. Um, so not everyone perhaps has $550 billion lying around, and that's where uh, you have smaller units available, which I'm sure everyone is uh, aware of, and those are the shares outstanding. But very few people look at, okay, what is the total uh, price at which I can buy the company. And it is important because then you know uh, your relative small slice in the pie. And if you are on Yahoo Finance, here you can find how many shares are out there somewhere here. Let's look at shares outstanding. Here you will see that 550 billion, was it 550? Yeah, well, it shows 600 billion is held by about 3.16 billion shares. Now it's very easy to arrive at one of the two values. If you know the market cap and you know the share price, you can divide the market cap by the share price to get to the shares outstanding. Or if for whatever reason you know the shares outstanding, you can multiply it by the price and you can get to the market cap. Now, why is market cap important as a filter? You have nano caps, mid caps, large caps. It's based on the total market capitalization. These are sliced, and bigger companies tend to grow slower, but they're also difficult to sync, whereas nano, macro, mid caps may have a faster growth trajectory but could be wiped off the market sooner. So depending on whether you want to bet on something more established and play a little safer, market cap could serve as a good filter. So market cap is good for a first filter, but you want to combine several filters to get to what you're looking for, your ideal match, so as to speak, right? And one other metric or filter that's better than market cap is enterprise value. And the reason it is better than market cap is it gives you a sense of how much cash and debt is there in the company. So enterprise value, if I'm not wrong, is calculated as market cap, which we just saw, and to that we add the cash in the company and we subtract the debt the company has. So you may want to think, is market cap, is it, if it's greater than enterprise value, if it's less than market cap, is that a good indicator, or do you want it to be more than the market cap? I'll just pause for you all to reflect on this. But the way you want to think about this is, when you buy a company, you also buy its debt, and you want I think I got this wrong. You add the debt and you subtract the cash. So when you buy the company, you also get the debt of the company, uh, but you also get the cash. Now, enterprise value, the question I was asking you is, do you want it greater than the market cap or less than the market cap? You can pause the video, think about it, and come to a conclusion yourself. And you can also go to Investopedia and validate if this formula is right. Or you can go to any website of your choice and see if the formula me or anyone on the internet is telling you is accurate. And the ability to verify the truth is very, very important, as an oops, not the multiple. You want to look at enterprise value formula, right? So let's see if I got this one right. Here, market, whoops, so advertisements. Enterprise value is market cap plus total debt minus cash. So let's see if I got this one right. Yes. So yeah, I don't know if you got a chance to think about if it needs to be higher or less than the market cap. Enterprise value needs to be less than the market cap, but I'd rather have, when I buy something, I'd rather buy something that has an enterprise value less than the market cap, because that tells me that the cash takes care of the debt. The cash the company has takes care of the debt the company has, much like how debt would work in your personal finances, right? You perhaps want to have more cash than debt, and then your net worth would reflect how much money you have plus the debt you have minus the cash you have could be your total net worth. Now, some of the other multiples you should be aware of is price per earnings. So price is, let's say a stock is trading for about $100, and I can think of Google, which should be in that ballpark. So let's see, Google, and there are two tickers for Google. One is Class A and Class C. It has something to do with the voting rights you have, but we leave that aspect aside. So we're looking at Google, which is a Class A share, which gives you voting rights, and the other one doesn't. That's the basic difference between the two. And you have a price which is not $100 but 91 as we speak, and it has some earnings per share, right? Now the P ratio, so let's assume this is about 5. We're rounding super up, and we'll also round this up. So this is 5 and this is 100. So 100, so my price is 100 and my EPS is 5. My price is 100 and my EPS is 5. So my price per earning should be 100 divided by 5, which comes around to be 20. So this is your P ratio at around 20. So for every $100, Google is generating about $5. Every about $100, very loosely speaking, Google is generating about $5, very loosely speaking, just for the sake of calculation. But we rounded both numbers up, so we're in the ballpark of the right P ratio. Now there are two variants of P ratio. One is trailing 12 months, which is looking historically, and then you'll look at something as forward P's in some cases, which are forward looking based on estimates. Now keep in mind, earnings is not the same as dividends. Earnings are put back in the business to take care of next year's costs, expansions, paying dividends, making acquisitions, buying back more stocks from the existing shareholders. There's there's several ways in which these earnings can be spent. Uh, some of the ones that I just shared with you all. Not all of this is dividend, so don't expect to buy this stock and get $5 at the end of the year. This is just the earnings of the company, and you as a part shareholder give back some to the company for it to continue its existence. And of course, for dividend companies, paying companies, sometimes this dividend is lesser, and surprisingly sometimes it's higher, because some companies, believe it or not, take on debt or issue more shares to pay out dividend. But you want to look at some of those health metrics like dividend yield. It's like, can the company even afford dividend? And you can look at these payout ratios as the payout ratio, right? Like, what percent of the earnings did the company give as dividends? Of course, Google doesn't pay any dividends, so you don't see any. But let's look at a company like Microsoft that pays some dividends, and we can look at the dividend yield here. So the stock is about $250. The earnings per share is about $10. So 250 divided by 10, a P ratio should be around $25. But you can expect a dividend. Ideally, you should expect a dividend less than the earnings. If the company is paying dividends more than the earnings, you need to know where the money is coming from. And if you look at the dividend paid, it's about $2.50. So let's see how much was the earnings here. Earning per share about $10, and the dividend is about $2.50. So the payout ratio is about 25%, right? The earning per share was $10, dividend was 2.5, so about 25% is the payout ratio. So 25% of the earnings was paid out as dividends, and the dividend yield, which is $2.50, the cost of the about $2.50, the cost of the stock is $250. That's about 1%. That's your forward annual dividend yield, which is forward looking, not historically, and trailing is very similar, 2.6. So there are two estimates here. Was the estimate on the price and the estimate of dividend, but they're very close for this company because it's a large market cap, super stable, does the same things again and again. So we looked at market cap. We want the enterprise value less than the market cap in ideal scenario. If it's not, we want to dig deeper how the company is deploying debts. We looked at price per earnings and where to find that and how to calculate it to make sure, if you work with data, not everything that pops up may be accurate. The other thing you want to know is price per sales, right? Like, okay, I'm buying a stock for X dollars, and how much money is the company making in terms of revenue or sales. So if I'm buying $100 stock, is it making $100 per share as revenue? You want to take a look at that. So let's look at a different stock in a different industry. Maybe we'll look at some healthcare stocks now. Let's look at Pfizer, and let's see what the price per sales is, right? So again, you can look at the market caps and the ones we discussed, right? You can buy the entire company for $220 billion if you have that kind of capital. Here's the PE ratio, about 7. Quick note on the PE ratio, right? Like, lesser the better. You want the price to be low and the earnings to be high. So price is the numerator, so lesser the price, lesser the PE. Earnings is the denominator, higher the earnings, lesser the PE. So you want the ratio, P ratio, to be less. We're looking at price per sales now, but you still want the price to be low. You want the sales to be high. You want the price per sales also to be low. And let's see if Yahoo gives us price per sales here. This is the P by S ratio. Again, TTM stands for trailing 12 months, which is a historic number, not a forward-looking value. There's another variety called MRQ, but we look at it when we look at price per book. So price per sales is 2.35. Okay, so the price was about $40, and the sales, you can guess the sales per share. They should be around 20, actually a little less than $20 for the price per sale uh, to be 2.35. So 40 by 20 is 2. You want, this is 40, so the sales per share should be less than 20, so should be in the ballpark of 15 to 20 for the price per sales to be around 2.35. So you buy a stock for $40 and they're making sales, not profits, sales worth about $15 to $18. Is that good enough? Yes, for sales, but we don't know the profit margins, right? So let's see if what the profit margin is like. Here we have a profit margin of about 30% and operating margin of about 40, and we look at those things, or maybe not, depending on how long we go on. But yeah, like, so let's assume we went for $15 profit. So we have $40 as the price. We have price per sales as about 2 for the ease of calculation, or let's say 2.35. So let's assume our sales of about $15 per share. Now with $15 you have a profit margin of about a third. So a third of $15 is $5 in profit. Now for every $40 of stock you buy today, you likely got about $5 in profit. Is that good? Yes, because $5 in 8 years, going back to our how soon can we double, in about 8 years, one of two things should double, or a combination, right? Like either this value should go up because investors realize that, or let's see if this pays dividends, right? So there's a dividend yield of 5%. So of those about $15 in earnings, about 5% are paid in dividends, right? And I'm rounding up. So 5% of $15, I don't know, is that 10% is 1.5, and 5% would be 75 cents. So you're getting 75 cents each year in terms of dividend. So is that good enough for you? That's your decision to make, right? So this is a P less than 10, and we look at cascading several filters, superimposing several of these into one another, and see how these fare. But let's look at a few more, and then we'll look at going from a huge sample, narrowing it down to a small value. Okay, so price per cash. As we've been going very, we looked at P and we looked at P by S, like price per earnings and price per sales. You can guess what price per cash is, right? It's the cash the company has lying around. Like if the company's you buy the stock for $40 and the company has $40 lying around, well, you're getting the business for free because the company has the cash you pay for and the business still exists. So let's look at some other example. Let's take one of the meme stocks now, AMC, and see how much cash they have lying around, right? Okay, so you can buy AMC for $5, and does this have any cash, or are they drowned in debt? Let's see, debt. Perhaps you know that, perhaps you don't. Let's see, cash. Here's the total cash, 631 million. and total cash per share is 1.22. Okay. I don't think Yahoo gives price per cash, but we can calculate it, right? This is the share amount, uh, and this is the cash per share. So price is let's take about $5, and cash per share is about $1. So price per cash should be 5 divided by 1, at the ballpark of 5. But this each ratio has its limitations. Like price per cash, I am not sure if it takes the debt into consideration. But we don't have to know everything, right? We can always go to Investopedia and look at price per cash and see if it deducts the debt, or just um, price per cash flow per share. So there's no such thing as price per cash, but there's price for cash flow, and we look at cash flow in a moment. But just okay, so this should be cash per share. This should be the inverse of no. Okay, we can leave this aside for now and come back to it. But what we're trying to look is how much cash is lying around, and there's several other ways to do that. This is a one easy filter. Remember, we're just filtering from a huge sample to get to a few stocks we want to analyze deeply, perhaps with ChatGPT a little later if we have the time and are excited about it. Okay, so I'll just quickly touch on another ratio, and we'll combine a bunch of these, and each of these have their strengths and weaknesses, right? Like I don't know if this price per earnings gives us any insights into debt. I don't even think price per sales gives us any insights into debt. Just you're producing a lot of revenue, but at the cost of what? You have a lot of earnings, but are you taking on a lot of debt over it? Same thing with price per cash. Let's look at price to earnings, like the PEG ratio, which is price to earnings, the PE basically, divided by the growth in earnings, or growth in earnings per share. You want the earnings of the share to increase, right? So if these are very intuitive, right? You want the price to be low and the earnings, sales and cash to be higher, so you want these ratios to be higher. Food for thought, do you want the PEG ratio also to be low? Because the PE, we want it to be low, that's the numerator, and the denominator is growth, so you want the denominator to increase. So you want the PEG ratio to be is something you want to think, right? Now let's look at examples where we combine all these concepts and filter a few stocks, right? Like we are doing this exercise because we don't want to be looking at an index. We want to be filtering a few things, right? So those were just the basics. Let's get these things all into action and combine these, and then we look at some spoon-fed formulas. But the fun is in doing it for ourselves, right? So I had this tab open with some of the ratios we discussed now, and we can look at these, right? So this is your price per book. Did we discuss price per book? We did not, actually. Okay, so let's quickly cover that. So a book value is the accounting book value, and you should be able to get it here. And let's look. Here's the price per book, and I promised you we can touch on MRQ is most recent quarter. And if you don't have to trust anyone, right? If you look at the acronym here, is the abbreviation guide, is the most recent quarter. So price per book is, okay, the stock was averaged at $5 in the last quarter, and the book value is the price according to the accounting books. And we'll look at some statements and perhaps see how we can calculate that too. Um, but yeah, that's the price per book. Again, you want the price to by book to be high or low. You want the price to be low, and you want the book value to be high. So you want the numerator to be low, denominator to be high. You want the P by P to be low. Is AMC a good buy? Well, just price per book is not a good indicator, right? We want to look at the debt. Let's see the debt. 10 billion in debt, and the cash is just 600 million. So uh, can they pay their debt? 630 million, about half a million, and 20 times the debt. But anyways, we're looking at price per book. This looks good, but if you look at the cash and debt, it doesn't look bad. So not all ratios give you all the information you need, right? Especially the debt aspect is we're blind to it. So something to remember in terms of limitations of some of these screeners, because that's what they are. They just help you screen, right? But they are still good screeners. So we want the price per book under 10. So we don't want the book value to be 10. We don't want the price to be 10 times the book, right? Because we are basically paying 10 times of what the book value is, however that's calculated. Like we can get into that, but that's basically, this means is according to accounting terms, you're paying 10 times the book value, and that's not the issue price, by the way. It's just the price that somebody comes up with in terms of accounting terms, right? Then we want the price per cash to be under 10. Like we want at least 10%. If we pay $100, we want the company to have at least $10 in cash. Just it's our criteria. You can move these levels however you like, right? And as you see, these are mostly fundamental values. We're not covering technical. I'll show you some aspects perhaps later, but this is mostly a fundamental analysis discussion, right? So then you have forward PE, which is forward looking, not this is sort of looking into the stars, but we want it under 10, which is we want to have, we don't want to pay more than 10 times what we expect the company to earn in the next 12 months. We want in fact the company to earn more than 1/10 of the price we pay today. That's more than 10% in returns, and that would give us the P by E of under 10. We touched on circle of competence early on. Like you can pick, like, for whatever reason, if you know a thing or two about insurance brokers, you can filter in your circle of competence, and there you'll find a company that has low ratios and is in the insurance brokers. I had picked internet content and information because I tend to know a thing or two about that than others, given that I work in the space. And then the fourth filter was price per sales, right? We want it under 10. In fact, we can even be a little more picky, and we can have it under 5. But we don't have anything, right? Like no company, given the other filters, has that kind of numbers. So let's increase these to, no, not over it. We want it under it. We wanted it under it. Sorry, my bad. So under it, these companies do show up. Let's put more stringent criteria and see under 5. Okay, still the same names. Let's go under 3. Perhaps 1 dropped out. Let's try under 2. Wow, these companies, we can infer, are making a lot of sales. But that's true about internet and content information, like content and information names that are less popular than the big ones. They make a lot of money in terms of sales. So here we have a few. We will look at Hello Group, which is based in China. And the other name that you perhaps may have heard is Trivago, which is a travel company, I think, which is based in Germany. But we are going to look at Momo in depth. Keep in mind, we used one, two, three, four filters, and we stuck to in combination. This is like the price per book is under 10, and the price per cash is under 10, and the price per earning is under 10, and the price per sales is under 2. If you want to add the filter of price per free cash flow of under 10, that brings us down to 4. We didn't discuss this ratio, but you know how to do it. Go to Investopedia, look that up, and read a little and figure it out for yourself. So we have only 4 actually that fit these criteria in the internet content and information industry, but you can go to medical devices, you can go to whatever industry you are the most comfortable in, and try and do the exercises we are about to do along with me as you pause the video at different points in time. So as I said, we're going to look at Momo in detail. But before we go there, I want to introduce you to some of the screeners that have historically been better than S&P 500. At this point, I think we can discuss a few of those. And there are the magic formula acquirers multiple. And we can look at how to emulate other great investors, because you can just clone or ape people smarter than you, and there's no shame in copying, at least in the investment world, because all we care is how soon we can double, the rule of 72. It doesn't matter if your idea was original, but be very, very who you imitate in this space, because hardly 5% of the individuals out there beat the S&P 500, and you want to look at the folks who have done that for extended periods of time if you're going to ape them. But before we get to those individuals, let's look at the magic formula. So magic formula is made up of 2 metrics, and I'll let you figure what those 2 are. You can either figure that out by reading this book, Common Sense: The Investor's Guide to Equality, Opportunity and Growth, by this individual author. It's a very, very good book. But if you don't want to look under the hood, that's totally fine. You can go to magicformulainvesting.com, and you can enter the market cap. And let's say you don't want to look at companies below 500 million market cap, you can select how many stocks you want to see, and you'll get a list accordingly. Right now, there's not even 30 stocks here. It's my guess. And try and see if you find names that are familiar to you. I can see Moderna. After COVID, you perhaps have heard of this name. Also Pfizer, that we just looked at. We also have HPQ for whatever reason showing up. Interestingly, Mr. Buffett bought this stock in the last year or at some point. But this is one screener. Again, you want to dig a little deeper. We're just trying to reduce the sample space we want to study in depth, because remember, we are trading our hard-earned capital, which is our goods and services, to somebody else's to multiply our capital. You want to put more thought than perhaps what you would when you set out to buy a car or a camera, because you want to deploy comparable capital for any meaningful returns. Okay, coming back. So magic formula is one way to filter these companies you want to study further, and you want to begin with the names. If you work in tech, maybe you want to start with HPQ. Keep in mind HPQ is different from HPE. Uh, they had split, so make sure you get the right ticker. Another good example here is AMC Networks is not the same as AMC that we looked at a few minutes back. This is AMCX, that was AMC. Um, Things like that, right? Like you want to look at the the ticker very well, because there are companies that have similar names, especially when you go down the path less taken. Uh, Now, just like magic formula, there's another multiple that also claims to beat the S&P 500, and that's the acquirers multiple. Uh, so if you go to acquirersmultiple.com, you can look at a few tickers here. Now, these are just the tickers. So here's Pfizer showing up again in this filter. Maybe something to look. Same thing about Moderna. Uh, Perhaps there's something there. But there's also a Brazilian energy company, PBR, that's showing up here, and another one, Equinor. But if you don't know anything about energy, it's okay to skip this one, even if it's better. If you think you have an edge in the medicinal field, you can stick with Pfizer or Moderna. If you read a lot of blogs about COVID and how vaccines are made, you can dig deeper into Moderna and Pfizer. Again, not stock tips, just examples that we are discussing. If you know a little bit about semiconductors, you can look at Micron as an example. Uh, if you're not from this region, you can still use the concepts of magic formula and acquirers multiple. So let's say if you are from the Indian subcontinent, you can just Google, Indian magic formula stocks, and here you have some names. Again, you can filter these further based on what you know about. If you know about IT, you can look at TCS as an example. If you know a few things about steel, you can look at Tata Steel or Jindal or JSW Steel. If you know about energy, I see coal. If you know about consumers, you can look at ITC and so on and so forth, right? Nestle is here, Cement is here, HCL Technologies on IT. We spoke about magic formula being composed of a few metrics. So under the hood, you can guess there's return on capital employed and enterprise value divided by earnings before income tax. So they basically stack rank ROC in the ascending order and EV by EBIT in the also in the order, and then multiply those two, and whatever company comes on the top, that's how you get the ranking of magic formula. And of course you can filter by market cap, as we did it on magicformula.com. So this website is Equity Master, and if you are from different regions, you can just look up magic formula for Canada or South Africa or Europe and so on and so forth. I'm sure somebody has done this work for you already. Just know how to see or validate the accuracy for yourselves. Now what was the other one? Acquirers multiple. So if you go to screener.in, again, if you are from the Indian subcontinent, if you go to screener.in and type in acquirers multiple, there are a few names that pop up, and as you would expect, TCS, Coal India show in both magic formula screener and the acquirers multiple screener on screener.in. Do not go out and buy those companies. We're just screening a few to look further. We haven't even begun screening just yet because I've been rambling for this long. We will start it shortly. We'll start it shortly. So those are some screeners besides uh, PB, the traditional ones like P by E, P by S, P by C, and there are others, right? Like everyone has their favorite. I'll just show you what other options are available to you. There's return on assets, return on equity. Now AMC has no return on equity, but whenever there's an NA, right, it's either because the value is negative or there was no earnings for this particular company. And NA could mean that they don't have data, but you know how to calculate those, or you know how to get to a place that will show you how to calculate those. So it's okay if a particular website doesn't have those for you. Okay, so now we did discuss about we could perhaps ape people who've done this better than us for a consistent period of time, and everyone has their favorites. And one good place to look for how the best of the best have done that for decades is Dataroma. And if you go here, and here, there's an advertisement for Masters in Asset Management, but we'll look at that a little later. But you can look at these individuals and what they've been up to, right? Let's see, do you know any names here? If you're looking at this video, you perhaps may have heard about this name called Buffett. Well, and of course I misspelled the name. Okay, let's try Berkshire. Okay, here we have there's Mr. Buffett and Berkshire. This was updated on 14th Feb on Valentine's Day, and there's an ad to we can cancel, and here you can see the most recent activities. Just a teeny tiny. Oops, let's just close these random. You can see that Mr. Buffett has been selling a few things and adding a few things like Apple, just a teeny bit actually. Paramount Global, but this is a very small percentage of his portfolio. But he added a little bit to about 40% of his stock is Apple, and he still continues to add there. Again, not a stock advice. This is what Mr. Buffett or somebody on his team at Berkshire Hathaway is up to. But you can look at a bunch of things, right? You can filter by activity. You can filter by what stocks on the S&P 500 are being purchased. You can see a combined. Looks like Google and Microsoft were some of the things that were active in this in terms of ownership. But we can see last quarter buys. Looks like Amazon and Meta are popular. We can do a bunch of things, right? Go play on Dataroma.com. This is the grand portfolio. Looks like of all the folks out there. I don't want to buy yoga pants. Of all the folks out there, these are the most popular stocks as done by percentage ownership. But we don't know when they bought them, right? Like maybe they bought it at a different price and these percentages just ballooned over time. But Dataroma is the website. There you have it. Go play. Now, that's for folks on the North American region. But if you are from the Indian subcontinent, I have got you covered. This website is Phenology, and if you look up ticker by Phenology and you look for super investors, and you can pick your favorites. You can either look at the late Rakesh Jhunjhunwala, or you can look at what Honorable Draupadi is up to, or you can look at what Mr. Pabrai is buying or holding. There you go. There's Edelweiss Finance, there's Suntech Realty, or you can look at what some of the international investors are up to in the region. And let's look at Aquamarine. Oh no, there's no. there's a way to figure that out, but you know what, we've been taking a lot of time, so here's Aquamarine. Again, Aquamarine is an international hedge fund based in Sweden, I think, and they are going to India to buy buy stuff. Right, this is managed by another great gentleman that I admire by the name Guy Spear, and you can see what he's up to in India, and looks like he's buying something like Apcotex Care Ratings. This is like the credit rating company in India, and there's Indian Energy Exchange, which is an IT company that lets you trade energy exchange. It's an energy exchange that lets you trade energy among the states, and actually Nepal, Bhutan, Bangladesh, and if I'm not wrong, even Pakistan trades energy on this exchange. But I may be wrong. But these are some companies that these are not popular names, but international hedge fund is looking at these. Maybe there's something they saw that we can perhaps try and uncover as a little puzzle. Okay, so that's about cloning or aping great minds, and don't just simply go aping them. They could have bought these stocks when they were incredibly cheap, but this is what they own, and it's a little puzzle to try and figure out why they own what they own, and try to look around. So these are some ways to just filter some of the things you may want to study much deeper. Please give me a second, but why don't you take a moment and try these websites, pause, get a drink for yourself, and we can resume in a bit, and we'll go much deeper in terms of a few quantitative exercises. Again, 6th grade, 8th grade level in a bit. Hopefully you had a moment to take a quick break. Now we started with talking about intrinsic value, and we can look at how to calculate that, right? Market price or market value is the price you pay, and value is what you get. So you want to have a decent sense of the value you want before trying to assess the value you are about to get if you make the purchase. And we're going to look at a crude representation of how Ben Graham, who is the mentor and teacher and employer of Mr. Buffett, did that, and how Mr. Buffett made his earlier millions. Again, this is not exactly how they did it, but the key concepts they used, with a high degree of resemblance to how they might have done it, or attempted high degree of resemblance of how they might have done it. Right? That's the networking net. It's simply called net. It's also called cigar, but way of calculating the intrinsic value. Basically, it's buying $1 for a few cents, or a rupee for a few paise, if you will, and we figure out or try and calculate those, right? So let's go back to our filter, right? So we put in our filters that we studied. We got 4 companies. I'm going to do Momo, but you can very well do Trivago if travel interests you. And at this point, I'd encourage you to follow me, right? So we're going to pick Momo, and Momo trades on the New York Stock Exchange, NASDAQ, like in North America, right? So I go to the NASDAQ site, I type in Momo. If you're doing this for a Indian equity, You can pick whichever, right? You can add the all the filters, the ones you like, come up with 10, 12 companies you want to study, pick one of those. If you are doing this from India, you may want to go to the BSE website, and we looked at IEX. You can do that. But for Momo, you can type in Momo and look at the SEC filings. You can download in the desired format. I would go with XLS format, because we're going to do a financial analysis, nothing too scary. Again, 6th, 8th grade mathematics. And if you're in the Indian part of the subcontinent, you can go to financials, and you can go to results and download. Let's see if you can download these. But I'm sure you'll figure out how to download these reports from the BSE website. If not, there's other websites like Money Control and the likes, where you could perhaps get access to the financials, the most recent financials, right? So we go ahead, go to the NASDAQ website, pick a ticker of your choice, and download the XLS file. And let me see if, so this is how it should look. I have this already open and just cleaned up a bit for us. But before we go there, let's just look at what the financial, the metric, the filters for Momo look like. Like, let's just validate what we saw on finviz on Yahoo Financials, right? We want single digit multiples. Oh, the P is not, this is not calculated because the EPS is negative. Well, that's not too good. Like, why is the earning negative? Right? We can look a bit into that. But the market cap is a little more than 1 3/4 of a billion. Enterprise value is much less. So what does this tell us? A lot of cash lying around, right? If you go back to our previous discussion, where enterprise value is market cap plus debt minus cash, profit margin is negative. That doesn't look good. But that doesn't always mean bad things, right? They could be investing heavily in the business. If that's the case, you want to see where they're investing and what they're up to. But operating margin is high. What's working for them is they have a lot of cash, right? This company, you can buy the entire company for less than 2 billion, and they have more than 9 billion worth of cash lying around. Now that's interesting, right? Like, the total cash per share is about $50, and you can buy a share for about $9. So that's, they have 5 times. So for every $9 you spend, you get $48 of cash. Would you take a deal? I'll let you decide. But this is a very crude way, right? We could miss something, and hence we look at something called. So I just put these metrics here so that you can look at these, right? You have the market cap of a little less than 2 billion. You have the enterprise value, which is less than half of the market value. So a lot of cash lying around, as we saw. There's no trailing P because there was no earnings. They were making loss, as we just quickly saw. But there's a forward P, which is analysts, when they look ahead, they see the company making some earnings. Now, not all analysts are right. Most of them are wrong. And why I say most of them are wrong, because mathematically not everyone can be above average. And if you look at the indices and funds out, well, not indices, ETFs and mutual funds out there, very few of them beat the S&P 500. Hence, historically, buying S&P 500 index has outperformed most of the analysts out there. But we're trying to figure out a couple of stocks that would do decent for us, right? So more power to them. Let's go on, right? Now the PEG ratio is less than 1. That's interesting, right? Now PEG is P by E divided by EPS. The numerator is We want it low and we want the APS to grow. This is a very, very good PEG ratio. And you can study others. If you you can look at other companies and pull out what their PEG ratio ends up being. Price per sale. So this company is making more in sale 1 year worth of sales than what you'll pay for this company's stock price as it stands today, or whenever I pull this data. It may not be accurate, but now you know how to calculate these and point out my mistakes even in these calculations. And the price per book is it's trading perhaps slightly above or around the price of its book value. So these are all good things. If you want to be critical, the company is not making profit as it stands today. But we still don't know what does this company do, right? Like you want to look at what Momo does. I know from filtering this was an internet content and information provider, but I'll let you take a pause and see what Momo does, and then perhaps come back and we look at the net working capital, so that this doesn't get just me talking to you and you working with these things, right? So if you've had a chance to take a pause and see what it does, you perhaps know that Momo is among other things owns a small portfolio of social media apps. It also owns Tantan, which is like the only Tinder come Bumble come OkCupid come plenty of fish in China. So a billion people have been locked down in China. You can perhaps hypothesize or rationalize why the company was in loss and China is about to open. And I don't know what do you think about human nature, but you can perhaps make a few guesses what the young population of China would be doing. One of the things the young population of China would be doing after things start opening again. Anyway, so one of the other interesting things, if you got a chance to read up on Momo, is they have a unique monetization model. It's similar to OnlyFans, but the content is much more cleaner. Is my guess. When I say cleaner, I mean it's more PG 13 or it's not R-rated as it can get in OnlyFans, but the concept of gifting, which is like if you admire somebody on some of the apps Momo Group has, you can buy them a virtual sheet. Like you can pay money, get a virtual sheet, give it to them, and then they can sell it back. And in each of the transaction, Momo keeps money. Now, this may seem silly depending on your culture, but gifting is very, very embedded in Asian culture. So rather than tipping directly, this is a subtle way of doing it. Much like how you've seen in Young Sheldon when Georgie is running the laundromat and doing some fun dealings there. Something very, very similar. And if you don't get the reference, look up Young Sheldon. But coming back to studying these financial statements. So financial statements have three things going on for them. You have a balance sheet, which typically come out quarterly, some cases 6 monthly, depending on the region. But quarterly cadence is pretty common. What you can see there is just two sections, assets and liabilities. And if you've seen this for Momo, this is how it looks. Nothing intimidating here. Assets is everything you want, liabilities is everything you don't want, but is needed to maximize the assets at a very very crude level. The other financial statements you might see is income statement, which is generally done annually. You also have cash flow, and there's differences. We spoke about balance sheet. Could be a point in time. Income statement is yearly. It's like your W2 or your income statement if you're employed in any part. W2 if in America, T4 if in Canada. In India, whatever your employer gives that you attach with your filing to a tax filing in March. So perhaps that's relevant. So that's income statement, but rather than being for individual, that's for you. Cash flow can be thought of as if you open up your banking app and you see money coming in and money going out, you see, okay, this much I came in from these sources and this is where I spend. That's what a cash flow statement is. We're looking at balance sheet. Balance sheet, to recap, is about assets, things you want, and liabilities, things you don't want. In a net, you want the total assets minus the total liabilities to be lot less than the price you're paying for the cash stock purchase, right? So if you downloaded, again, I'm doing this for Momo. You download the balance sheet for whatever you like, and put it in a structure, something very similar to this. I'll share this one, but I encourage you to just make your own Excel sheet. That way you understand each line item once, and then it will become very intuitive if you do that. So in the asset section, you will likely have subcomponents that make up your total assets, which is this. And I took perhaps two companies here. The green one is Momo. So you have your cash. Now you can assume all the cash you have is yours. So you just multiply it by 1. All the cash is yours. You have short-term deposits, which is maybe you made an FD and you can or bonds of companies or lights. These are cash equivalents. Now, what qualifies as cash equivalents? You can go to Investopedia and see what, but it's not hard cash. It could be marketable securities, which could fall by 10%. Hence, we put a multiplier of 0.9. And you don't take the exact value, you add a multiplier. And then there's short-term deposits. Cash equivalents was here. You have short-term deposits, you have restricted cash. If the cash is restricted, we just take 15% of that value and add it, right? Now you have accounts receivable, which is, people who owe you some money, it's yours, it's going to come, but let's say 20% of them defaulted, so you just assume only 80% is going to come for the company. And then there's prepaid expenses. This is all yours, but you just multiply it with half because maybe whoever you paid the expense to can go out of business. So you take all these things, right? You add these up, and this again, another set of multipliers. We're not going to go through all of them. You can look at these. You can look at the multipliers I've used. You can use different ones, right? This multiplier table is how you assess it. If you don't want to use different ones, you're welcome to take this. But once you add a multiplier, you have to understand this is as close to scientific, but these are all assumptions. This may or may not end up being true, but these add conservatism. And we started with total assets of, these are in million, so about 2 billion, and we reduced them down conservatively to about 1.8 billion. And I did this for some other company, I don't remember which, but here's another example of me doing it. It should come back to me. Was it an Indian company, just to show? No, it's in US dollars. So You can download this, add these multipliers, and see what the total assets are. These multipliers will help you mark a few things down, which may or may not uh, come back to you. Like, prepaid expenses was one good example, and non-current assets or rental deposits. Those things, something could happen, and those couldn't be your assets any longer. But deferred taxes, you can expect the government to be around, in this case CCP, to be around with a good long-term perspective, or at least short or mid-term perspective. So you have the total assets, then you have the total liabilities. You don't mark down the liabilities. You, in fact, if you like, you can bump them up a little. So you have the assets, you subtract the liabilities, and what you get is the net working capital, right? Now you want, so this is everything the company has minus everything the company has to give away or does not have. Now you divide this with the total number of shares that are out there, and you already know how to find the shares outstanding. You can either look it on the statement, or we can go here, and you know how to calculate shares outstanding already, right? You can take the market cap and you can divide it by the today's price, or you can go here and see there was a shares outstanding here, right? Shares outstanding 193ish. Let's see what I've got. So I've got 193 as one value, but if you look at different 193ish as and again, assume the units. Like, I'm not going to go towards the decimals here. We're taking the most significant digits. If you're looking at different sources, you could see also a number close to 385. That is because if you buy the stock as an ADR, which is just a way to buy this Chinese equity on US stock exchange, you will get two stocks. So if you buy Momo on US, like Momo, the ticker on NASDAQ, you will effectively get two stocks of Momo, the Chinese entity. And that's why you'll see this discrepancy if you're using any other source, could be the NASDAQ source other than Yahoo. So if you're getting that difference from the current market price, and you can use this formula if you're using Google Finance, Google Sheets, Google Finance. You can put in the ticker, put in the price, and based on the live price, it will change your calculation. So this is near real time, and all you want to know is your what is the market, what is the market capitalization, what is the net working capital, and what is the market cap of this company, right? Now if you look at the company's net working capital, and if you look at the market capitalization, and if you take the assets, you subtract the liabilities, you get the net working capital, and you get the market cap. Now, is the net working capital less than the market cap? And the answer is yes. So this may not be a pure Graham. What I mean by pure Graham is this is not buying $1 for 40 cents. You are buying $1 to, say, a little over $1, which we saw in the price per book value for this one, I think. price per book. It's slightly expensive though. Now, but there are companies which have uh, okay, this was an example of a company which had the assets minus the liabilities, giving you the net working capital, which is less than the current market price. Now, I would have given this ticker. The reason I perhaps didn't put the name here is okay, 6.22. Is this? It should be US dollar September 2020. Yeah, this is an example where the net working capital is more than a market cap, and I didn't want to give the ticker, and I honestly forgot which this company is, because I didn't want this to be about stock tips, but you can definitely look for companies that are out there. In fact, you can try and figure out which this company was. Was it Trivago? Was it some other company? Yeah, this is how, if you really want to do the numbers, you could do it. Again, at a high level, you take the assets, you add some multiplier, you subtract the liabilities, and that you want it as close to, ideally less than, what the total market cap of the company is today. Very few qualify as less, very few come this close even. Momo is one of them. But we can even use ChatGPT to do this for us. I think, let's see, do I have it open? I could open it. Oh yeah, here. So we can ask, what is the intrinsic value of Momo based on the data you have? Please calculate using DCF, which is the discounted. Whoa, what happened here? Let's see. Okay, let's try and repeat the question. Please calculate, and you can do this DCF based. You can try this on your own. Open up ChatGPT and ask the same question, or any question you like, based on the concept we discuss, and trick it into give you the answer by saying pretend to know, whatever. You can see this right now. Please calculate DCF based intrinsic value for Momo based on the data you have. Yeah, so it will first tell you that, hey, this is not what something I can do, and then it says, if you can provide me with this information, I can help you calculate the discounted DCF, right? Assume the discount rate. So discount rate is the rate you apply. It's like the inverse of interest rate. It's a crude description, but a cash flow tomorrow would be worth a lot less today, and this is the rate you discount it by, and we'll tell it to assume 12%, which is very conservative. So now it's popping this value, right? And it made a few projections on the company's free cash flow, which is the money coming in. It put it in the formula of DCF, and then it's assuming a different free cash flow for year 6, I believe, here, and then you can see the formula. So it came up with a discounted cash flow, and then let's see what the estimate is. Intrinsic value is about 6.7 billion. Can you please give an intrinsic value per share? So now the shares could have reduced since 2021 data, that is when this was trained. So, but it's coming up with the intrinsic value per share for about $50, and that's actually pretty close to some of the DCF based calculation some of the others screeners would do, right? So there are several DCF calculators. You can enter your assumptions and have it calculate, these calculators make projections on intrinsic value for you. What you're trying to do is pay less than your projections of an intrinsic value. Now, don't trust chatgpt. It's saying the intrinsic value is about $50, and Momo stock is trading for $9, but you want to calculate this intrinsic value for yourself. We looked at net, which is very rare to find a company on that's trading for a few cents than dollars in today's world. It happened in the last century quite often. It does happen in some small micro nano caps even today, but you want to try DCF. We generated this by ChatGPT. You saw the formula there, and you can look up the formula. If you go back to 6th grade and you travel back to time with me, you started with some principle, and you added some interest, and you used simple or compound interest and got to an amount a few years after. DCF, or discounted cash flow, is the inverse of that. Like you start with an assumption where you want to be in a few years. You generate the free cash flow, which is the cash the company is generating, and you discount it for today's value. You come up with a price. You see if it's less than the market value. If it's marginally less, then you buy. And there are many DCF calculators. You need to have a good sense of how much cash you want the company to generate. You could make estimates based on historically was the free cash flow coming. Where you look for is the financial statements that you can either find on Yahoo or Money Control or many different sources, which I can do as a recap. And then you can then, if the intrinsic value is much less based on your calculation than the market price, you could buy that, because eventually the others will figure out what you figured a little bit before them, and you can capitalize on that. That's how share price in an auction driven market goes up. Okay, so there are a few other resources that you want to look at. I got logged out of these, but I'll just probably pause this video and record those. But as a quick recap of the resources, you have Investopedia for definitions, finviz or for filters, any finance website for looking at the ratios or key metrics, or even the financials like the income statement, balance sheet, or cash flow. You can filter by existing things that have worked in the past, like Magic Formula, investing.com, or Equimaster that gives the same formula for India. You can look at acquirers multiple. This individual also has an ETF if you don't want to do this homework by the ticker deep as in deep value, DEEP. Again, not an investment suggestion. Uh, you can look at acquirers multiple in India and some of those stocks that show up. You can look at Dataroma to see what Mr. Buffett and other smart folks are up to. Similarly, you can look at ticker by phonology if you're in the Indian subcontinent, or a quick search will give you these filters for your region, right? You want to emulate the best, and how you qualify them as good investors is totally up to you. Another good resource is the Berkshire Hathaway website. You can read these letters, the most recent one. You can go there and read this annual report for Berkshire Hathaway for 2022. And Mr. Buffett is a incredibly articulate person. Much more, you'll get to learn a lot more than a random stranger on the internet can tell you in a recording. And then what are some of the other resources we touched on, right? We looked at the NASDAQ website, BSE website. We looked at chatgpt, of course. We can't really make a video. I'll just quickly pause this one and record again. There's two more different examples of the same thing to cover, and then I'll wrap it up with a few resources for you. But just give me a moment and I'll be right back. I didn't realize I was talking for 90 minutes, so I'll wrap this up quickly. So depending on what services you have from your broker, right, you will be able to get most of these things easily. Some you will have to work hard for, like the net working capital. But there are free DCF calculators, and in the interest of time, I won't cover them. As I said, look them up. But here, let's look at Momo from two different providers again. What we looked today was mostly fundamental analysis, but if you believe in palmistry and fortune telling, there's another strain of investments which is called the technical analysis, which is trying to look at these candlesticks and predict the future. I'm not very good at that, and most value investors shy away from making predictions. They just try to get the difference between the price and value and take it from there, right? So pretty standard stuff. There's no PE ratio because earnings were negative for Momo. There's still a dividend, which is nice because they have a lot more cash than the company is going for. Here's a few details on what it does. We touched on that. The earnings per share are increasing, which is good. They're also beating analyst expectations, which is largely irrelevant because they want to beat your expectations. Fidelity calls these undervalued, good quality. You can dive into deeper as to how Fidelity or the data this particular provider is getting it from, calculates these weak short midterm sentiments, but long term this seems to be good according to this data. But we already know that because they have a lot of cash. Few reports, I don't look at these, but definitely the market cap is something we touched on. P by E. You can look at more of these. You know what? Let's look at these key statistics because we like looking at these, right? There's P by E, there's PEG. These don't exist because there's no earnings. EV is a lot less than market cap. Price per free cash flow. Price per cash flow. Most recent quarter, there is some cash flow, but if you look at the past 12 months, there is none. Price per sales is 1. That's really good. Price per book value is 1. Really good. Slightly different than the values we saw earlier, but you know how to calculate those. Other metrics, I'm not going to go through these, but profit margin looks incredibly impressive. Very little debt. losses per employee, but revenue of about 1 million per employee, uh, at par with most interactive media services, but very good for a company based out of outside of North America, because this is in dollars, which is a stronger currency. But you can also compare Momo to its peers, right? Match is the parent company that owns Tinder. Bumble is a very similar matchmaking platform for dating and friends and the likes. Uh, but you, if you compare this, right, you notice the price. This doesn't matter, and we quickly touch on that because I've tended to be verbose in the rest of the video. Uh, but this is the only one to have increased its stock price in the past 52 weeks. The Tinder, or the Match, the parent company of Tinder, fell 70%. Bumble fell 20%, whereas this particular did much better in terms of volume of stocks traded, which again, not a fundamental analysis character. They were fairly comparable. 90-day average volume, uh, you know, is comparable. Like nothing big there. This has the lowest market cap, least institutional ownership, which can be a good thing for a retail investor because this is not overfished, but not always. Uh, the bad thing is did not make any money this year, but did make a lot of revenue relative to its peers, and given its market cap, which is much less than Match, and has fewer shares outstanding, and that's a good thing relative to others, is because when you buy one stock you get a much larger size. And let me show you a better example of what positioning, sizing, or volume means. By the way, I was able to look at this particular stock. This is Gigam, GIGM, which is a media services company based in Taiwan, which is trading a lot less, like a few cents for dollar, and as it stands today. But this is an example of a pure net that Mr. Buffett in his early years was after, when he was a ardent follower of Ben Graham, the author of Intelligent Investor or Security Analysis, before Charlie Munger pulled him away from just buying few cents a dollar and investing in not just any company at a cheap price, but great company at a fair price. On the closing thoughts, right? You want to think about percentage ownership. Now, if you take two stocks, Baba and Google, they're both about $90, but have very different market caps, but are in the same space. If you were to buy 1,000 shares, it would cost you about $84,000 for Baba, and about $91,000 for Google. Now you could add any multiplier, right? The point I'm trying to make is that for about the same capital deployed, you will get about 4% of 4 times, not 4%, 4 times the slice of pie for about the same money in two different companies. So while people think mostly in terms of the share price, very few people think in terms of percentage ownership. But if you're buying a share, you want to know for about the same amount of money for two different stocks, you could get 4 times the slice, relative slice of the pie, in this case, of the company. So again, these are not investment advice. There's nothing here is investment advice, but all I'm trying to tell you is you may want to think in terms of percentage ownership, because a share is part ownership in the company, and you want to think like a owner if you're buying for long-term holding, because then you'll perhaps think like what the CEO would be doing next, and you would be able to assess the company even better. And for those, there are checklists, and checklists are very personal to avoid the mistakes you did in the past. So if you were to be very objective and put together all the mistakes in investing you've done in the past, you can come out with 5-10 things like I bought too high, or I bought the wrong company, or I bought it because somebody told me. So you can just ask yourself, right? If you bought too high, the question to ask yourself is perhaps like, does it smell like fear out there? Because typically when people tend to oscillate between fear and greed. So when they're fearful, the stock's very cheap. So if the answer to the question is, does it smell like fear out there, and the answer is no, whether you're buying a stock or a house, then perhaps you will end up overpaying. But the point, you want to make a list of your mistakes and ask yourself questions to counter those biases, because we tend to repeat the same mistakes again, especially if we don't study those. And the other thing is about position sizing, right? So now let's take a company, and you have just 10 stocks in your entire net worth. Like your net worth could comprise of your house, cash, stocks, right? So let's say stocks comprise of just 20%, right? And we can work with 50,000 as net worth, whether rupees or dollars, just to make the calculation easy. And of that 50,000, let's say 20% is in stocks. That's 10,000 in stocks. And let's say you decide to put 10% of each of those in one different company. So that would be $1,000 each, and one of those stocks goes up 5 times. Well, that 1,000 became 5,000. Your stock portfolio had an increase in 50%, but your net worth increased by 5%, right? Because 5,000 is 10%. 5,000 is 10% of 50,000 we started with. It's 50% of the 10,000 if you're just comparing with stocks. The point I'm trying to make is position sizing. Once you find a really good investment for a really good price, and you like everything about it, you know everything you can know about it, then the conviction reflected in terms of capital or percentage of your capital deployed matters. Now, if you put all 10,000 there and it went 50,000, you would have essentially doubled your net worth. You would have gone from 50K to perhaps 90, 100K. So you would have doubled your net worth if you put everything in a high conviction bet. But if you make it a low conviction bet, you may get meaningful returns, but once you've done your research, all I'm trying to say, you have to have the intestinal fortitude to act on it. And you get that by solid research and some emotional composure to hold it through downturns. You can also pace your investments, like you can sort of dollar cost average how you do an index and enter at different times and gradually increase your position size. But if you want meaningful returns as an enterprising investor, your position sizing matters, your percentage allocation matters. Otherwise, this just ends up being a intellectual masturbation, something you can talk to your friends at a dinner party or at a cocktail party as you pull out your pinky and clink those wine glasses. But those are some of the things we already spoke about. Percentage ownership, like you can own a much bigger slice of the pie for the same capital deployed. We looked at the share letters, and the last thing I wanted to touch is if you are going to be in Omaha, Nebraska, where other value investors meet this year in May, I'd love to catch up with you all. But with that, good luck on your journey to value investing. Hopefully, some of these resources were helpful, and you can perhaps come back to the parts of this video and do a few things by yourself, including poking around with ChatGPT. With that, hope you have a great day and happy investing. Take care.